Hi, a very good evening, and welcome to our segment on Ask Me Anything, brought to you by the Institute for Financial Literacy. I'm your host for tonight. My name is Trevor Tan, and we're going to talk a bit about how much life insurance should you have. So very quickly, let me just set the stage for this. So a very quick disclaimer, this webinar is designed to provide you financial literacy education and to help you evaluate information out there. So it's not designed to help you in terms of product selection. So any mention of companies or industry, it's purely for illustration purposes. So if you should need to get advice, please consult a licensed financial advisor before you make any form of decisions in buying an insurance product or whatsoever. So how much life insurance should you have? That's the question that I think all of us bring tonight. And because life is unpredictable and you kind of want to protect yourself against all this uncertainty, and that's why you buy life insurance. So what we're going to be attempting to do is to share with you some thoughts, a very short segment at the beginning. I'm going to take the next maybe 8 to 10 minutes to just cover a few slides, and then very quickly we would go into the question and answer. So you probably be asking, should I buy term versus whole life? What's the difference? How do I choose a suitable product? Yeah, in terms of life insurance product, which one meets my needs? So first, we're going to go back to the fundamentals, basics. Yeah. So what is life insurance? Life insurance is actually a risk transfer tool where individuals like you and I can pay a small premium, small is relative, to an insurance company or an insurer, we call it, so that they can bear a large-scale financial loss, more often than not, something that we are unable or unwilling to bear in the event it happens. All right. So what are some of the risks that can cause such a financial loss? Yeah, so some of the financial loss that are covered by life insurance here in Singapore would namely be, the first thing would be across the board, death. Okay, this is covered by whether it's a whole life plan, an endowment, or a ILP product. All right. Secondly, you would see total and permanent disability. Okay, this is covered basically by most or all whole life or term life products. Okay, HNS is, or hospitalization and surgical benefits, is something that you can add on, and this will cover hospital stays and surgery. Okay, the other area that is commonly added as a benefit to most life insurance policies, and it's very popular, is critical illness, or in short, we call it CI. Okay, and this pays a lump sum in the event of a diagnosis of a list of 37 illnesses that are currently covered here in Singapore. The final category that you see on the slides is a less common one, which is disability income. And this covers you for temporary or partial disability in the event you are unable to work, and you will pay a monthly payout. So some things to think about. What are the factors, before you jump in and decide, oh, how I'm going to decide what type of insurance I should buy and how much I should need? These are all quite fundamental questions that you have to deal with. Yeah. So first things first, you see is you need to consider the age of your dependents. So the age of dependents will determine how long you need to provide for them. So the dependents can be young children, can be I would think at least those who are below 16, because in Singapore, age 16 is legally when you can start work. Yeah. So young children below the age of 16, non-working spouse perhaps, your elderly parents, or maybe a sibling who has special needs, or anyone who depends on you financially. Those are your dependents. The next question you might want to think about is budget. So the Life Insurance Association recommend using a maximum of 10% of your income. So this is after taking care of all your basic living expenses, yeah, in terms of a monthly budget. All right. What about existing assets that you may have, like your CPF, your investment, like your unit trust, REITs, ETF? All these you can also factor into the consideration. Okay. The next thing you want to think about is perhaps standard of living. So if I'm no longer around, the question that I would ask myself is, do I want my family to continue living in the same house we live in now, drive the same car that we're driving now, or it doesn't matter, they can go and take taxi, they can go and take MRT and buses. Yeah, so that's something that you need to think about. Finally, what are the debts and other obligations that you may have? All right, so this will be in the form of maybe a mortgage loan that's outstanding on your house. Maybe you took a reno loan to renovate your house 2 years ago, 3 years ago, or car loan or study loans. So all these factors will affect the amount of insurance you do need. Yeah. So let's very quickly look at what are the broad categories of life insurance products here in Singapore. So as you can see on the screen, we have in the first column, first category, you have term, which is what we call unbundled product. This is pure protection. So this is where insurance all started. It's a pure protection kind of policy. All right. So this in itself is actually the most affordable kind of policy you can take up. And then quite a number of times, this can come with renewable convertible options that you can take up. Some companies offer it as a package. Some companies you have to add them on. All right. So the renewability and convertibility features are very useful because let's say you buy a 10-year term. At the end of 10 years, it may automatically renew, or within the 10 years period, you can convert it into a permanent policy like a whole life or an endowment without having to show that you are in good health. So that's that's the advantage of the renewable and convertible option. All right. So the challenge is that the premiums on term plans would always be revised when you renew or when you convert. Okay. Or if you buy a yearly increasing term, yearly level term, then every year the premium is going to keep increasing. So that's one of the disadvantages. In terms of whole life and endowment, these are also very popular. And in Singapore, I think most people like the idea of participative whole life or endowment plans. So as the name suggests, you're participating in the, basically in the profits of the company, and this tend to be a bit more expensive. So they would give you not just coverage, but some form of accumulation in the long term. So it would have both the feature of, guaranteed and non-guaranteed cash value. Yeah, so that's something that you need to think about. The last category is the investment linked plans. So this is a hybrid between what I have called earlier mentioned term and an investment account. So it offers quite a bit of flexibility. But one of the things you need to bear in mind is that in this case, there's no guaranteed values in the policies, and you have to bear the entire risk, but of course you get the entire potential returns. Okay, the other thing to note with ILP is that the mortality charges or benefit charges goes up as you age. So that's one big criteria to think about. Another issue is that there will be constant fees and charges of the policy benefits that will erode in terms of eroding your returns. Yeah? So if you're looking at ILP as an investment vehicle, you got to bear that in mind. Okay, so direct purchase insurance is something that we just want to mention here. So back in April 2015, this was launched by MAS to basically offer another avenue for Singaporeans to look at life insurance. Yeah. So what happens is that if you are interested in DIYing yourself, DIY in terms of insurance planning, you can use direct purchase insurance products available across all the registered life insurers here in Singapore. So what you need to do is just go to the Compare First website, and it's a very good interactive website that you can check out the different plans that are available. Yeah, so you can look at term and whole life products, and it's also you would have quite a bit of cost savings because there's no commission payable. And you're dealing directly with the company. So what you're going to get is potentially about a 7% savings in terms of cost. Okay, so if you're interested in term, you can buy up to 400,000. If you're interested in whole life, the maximum is 200,000. But this is based on each company. Yeah. All right, so that covers the basic part that we want to just take you through very quickly. So right now we're going to move into answering some of the questions that were already posted earlier. Okay, my colleague is going to help us, set up Slido for this. And as he's doing that, I'm just going to stop share screen and look at some questions that were already posted earlier, okay, by you guys. All right. So actually earlier there were some questions that were posted online already. So I think it will be good for me to answer those few questions before I go to those on Slido. Yep. Okay, there was a very interesting question that was posted yesterday on Facebook. And this is a question by Siu Wai. She said, I read that one can sell one's life insurance policy to a third party for cash at higher price. I'm unsure what is this all about. Can you explain? Okay, so what she's talking about is actually this concept, okay, or this whole idea of what we call traded life policy. And originally this actually came out of the US. Okay, so what happens? Originally it was called traded endowment plans, most of it, yeah, but now whole life policies are also traded. So fundamentally, what is happening is that a life policy is being sold by the original policy holder. Okay, as in, like, for example, now I'm thinking I don't want to keep paying the premiums on this policy, but I want to recover some of the cash value in there. So what I can do is approach companies that are set up to do this, and they would have buyers on the standby, or investors, okay, who are interested in buying a policy. Okay, and basically they have a mechanism to determine what would be the price. So to the person who is buying this, the investor is buying this, they are probably looking at this as a potential investment return. All right, so commonly this is what we call a second-hand policy. Now the thing to note is that MAS does not regulate the sale of this traded life policy or traded endowment plans, which means what? Which means basically, if you do decide, to go into such a transaction, whether it's buying or selling, MAS is not regulating it. And should anything goes wrong, because they are not licensed currently by MAS, okay, you pretty much be on your own. Yeah. So you would have to be very careful, make sure you kind of read and understand all the terms and conditions before you jump into anything like this. All right. Okay, let me look at Slido now. And okay, so buy term and invest the rest. That's the question on the very top popular statement. What are your thoughts? Oh, okay, good question. Buy term and invest the rest is actually very similar to an ILP concept. Okay, so what you fundamentally do is that you don't mix your insurance with your investment needs. You take it apart. Okay, so you buy a pure term product, and term these days can go up to age 99. Okay, and then whatever money that you may have set aside for a whole life plan, you take the balance and you invest it on your own. So what you can fundamentally do is maybe invest it into REITs, ETFs, unit trust portfolio, or you can even seek go to platforms like robo-advisors, which use fancy algorithm, and it's just investment apps. So online investment apps that you can log on and put in all your information, and they will use it to build a portfolio for you. So that that can be the fashion that you approach this. So I for one would feel that that's a good option for people who don't want to mix their insurance needs with their investment needs, and is clearly segregated. All right. Okay. Are there benchmarks in terms of how much life insurance or critical illness you should have? Okay. I think LIA has got some guidelines. Okay. So what LIA suggests is that you probably want to look at for critical illness, covering yourself for up to about 3.9 times of your annual income. Okay, because critical illness is not just about medical expenses, but basically about potential loss of income because you are maybe forced to stop work. So you have ongoing, once you're forced to stop work, you may have ongoing medical expenses that cannot be covered by MediSave. Okay, and your Careshield Life and hospitalization riders will only cover you for in-hospital stay. Yeah, so that's why they suggested 3.9 times of your annual income. In terms of how much life insurance you should have, I think just now we mentioned all the different factors, and I would suggest that perhaps you want to also consider using the CPF website. They have a life insurance estimator on there, and I feel that that's one of the most accurate tools that you can use without having to sit down in front of a financial planner or insurance planner and getting stressed, that, well, at the end of the day, I'm going to be like kind of cornered into buying something. All right, so that's a DIY method, which I strongly encourage you to look at. So I hope that gives you an idea in terms of life insurance coverage, but of course, there are people who say at least, about 10 times your current annual income, but I don't think that's a very accurate gauge. Yeah. All right. The questions are looking fast and furious. Let me see. Okay. So if you have term, is accident still necessary? What's the difference? Okay. Both term and accident policies would cover. Okay, term policies covers you for death regardless of the cause. Okay, so it can be an illness, it can be an accident, but accident policies would cover you purely for accidents. All right, so if a death happens because it's an accident, and you have both, then both policies, both the term and the accident policies will pay out. All right, so that's the fundamental difference. Of course, if you just have a term policy, you just have an accident policy, sorry, and then you don't have term, then what can happen is, what happens if the person dies because of the illness? Then the accident policy doesn't pay at all. All right. So the reason why people take term policy, accident policies, is because accident policies, the premiums are much lower. And I suppose for the younger people, the risk of dying of an illness is much lower than the risk of dying in an accident. So I hope you understand that difference. So that's why some people, while they are very young and they are very active, they would take up a bit more of accident insurance to cover in the event something like this happen. Okay. As a rough benchmark, how much of my monthly income should I be paying for all my insurance policies? Okay, so here again, LIA has a guideline. They suggest that you set aside no more than 10% of your annual income for insurance premium. Okay, I just want to stress, actually 10% is quite a bit. And if you look at term as a solution, you may not need 10%. Okay, you may need a lot lesser. Okay, so I for one, if you ask me today, I've got four kids, 3 are young adults. I help them with all their insurance planning. I'm a strong advocate of term insurance. Yeah. So if you say as a guide 10%, okay, especially if you have a mixture of insurance plus investment put together, whether it's an ILP plan, a whole life plan, or endowment. But if you're taking them apart, I think you don't need 10%. Okay, you probably need you need a lot lesser. All right. Okay. Do I need DPS when I have my personal life insurance? Yeah, good question. Okay, so DPS is Dependent Protection Scheme. This comes under the CPF board. And the reason why CPF board set this up, which provides a coverage up to 46,000, which is not a whole lot, okay, is because this is to cater for the lower income group who don't have the financial means to look at taking up personal life insurance. Yeah, so what they can do is, you know, if you have been working forever and you started contributing to CPF, you know that the moment you started working, DPS automatically get locked in, okay? But you can actually opt out of DPS if you want to, okay? So the whole thing about this is the coverage is low, the premium increases as you age. So if you have got sufficient life insurance coverage, I don't think it's really critical. Yeah, so like I say, it's designed for the basic needs of the low income group who don't have a lot of cash, disposable cash to buy life insurance, and they can use their ordinary account to pay for the premiums. All right. Okay, so I hope I answered that question. Are DIY insurance products better than those marketed by life insurance agents? They are basically fundamentally they are the same products. Okay, the DIY products that you saw earlier, the DPI, that's offered by all the life insurance companies here in Singapore, they basically the same products, whether it's term or whole life. It's just that you are buying them directly from the insurance company, and the thing is that most of these DPI products are very plain, simple vanilla products. Okay, so they don't have too many frills added to it. So you can buy a term to age 65, or you can buy a term to age for 20 years, and then you can add critical illness to it. So that's the thing, and there's fundamentally no difference. Okay, the only thing you don't get is you don't get advice lah. Okay, so you don't get advice of an insurance agent, but on the other hand, you also don't pay commission. All right, so that's the fantastic part of it. Yeah, and you can compare all the different companies until the cow come home. Okay, because the website is so good. The Compare First website is so good. All right. Let's see. The questions are moving fast and furious. Did I answer all the questions? Okay, now I understand that I can nominate my beneficiaries for life insurance just like CPF. Can you explain more? Okay, so this is one of the questions that were asked earlier also. Okay, so for life insurance, under the Life Insurance Act, okay, there is two forms of nomination that you can do. Okay, two types of nominations. So there is the trust nomination under Section 49 of the Insurance Act, Section 49L. Basically, as the name implies, when you do a trust nomination, basically as a trust policy, you as the policy owner will lose the control of the policy, including the death benefits, the living benefits, and all that. So you can nominate, for trust policies, you can nominate your spouse and your children for this. Once the nomination is made, it's not revocable, and a will cannot replace the nomination done under a trust. All right, so it's a very rigid kind of nomination. So most people won't go down that route, okay? Especially if, let's say, a marriage breaks down and then the divorce, the trust nomination cannot be set apart, okay, except by going to court and asking the courts to have a court order to tear it apart. So it can become very sticky. But why do people still take trust nominations? Okay, in the past, this was done largely for estate planning purposes, and also mainly for business people, especially today, a lot of us may go into side business and all that. If we are worried that our business fail, and then we may land up in bankruptcy, then what will happen is that a trust policy will protect the policy proceeds from the claims of creditor. So that's the unique benefit of a trust policy. What is more common is a revocable nomination under Section 49M. Okay, so this one, most people do this all the time. So this nomination can be changed anytime. So when you get married, you can change. When you're not happy with the beneficiary, you can change. So any other time. So this can also be revoked using a will. Yeah. So I would say doing a nomination under your life insurance policy is actually very advantageous, and you should have it done because you can control exactly who benefits from the policy. And incidentally, to just add on another point on this is that with a proper nomination done on your life insurance or policy, it actually kind of speeds up the claim when a claim is filed. Because under the Insurance Act, okay, basically the under Section 61 of the Insurance Act, actually, the Act allows life insurance companies to pay out up to 150,000 to the proper claimant, okay, without producing the letter of administration or probate. So I had an experience like this where the claims was paid out actually in 5 working days. So it really helped speed up the whole claim process. And one of the advantages of this particular clause is that every insurer can pay up to 150,000. So that's also another reason, maybe I should share this here, that you should not put all your eggs with one particular insurer. Okay, you should kind of diversify it, because if you have one with A, one with P, one with N, then it's 150 each, that amounts to 450. But if you put all 450 with one company, then that one company can only pay 150 upfront and the 300 upon clearing the probate or the letter of administration produced. Yeah. All right. I have Eldershield. Should I convert to Careshield Life? Okay. Good question. I will just touch a little bit on this because 2 weeks from now, we're going to do another segment on do I need another health insurance policy. So Eldershield and Careshield Life actually are health insurance products. Okay. So Careshield Life and both Eldershield are both long-term care products. And Careshield Life was just launched in 1st October last year, 2020. So if currently you are on Eldershield, I would suggest doing a few things. Is to look at the benefits of Careshield Life first. Anyway, the cohort that is under Eldershield cannot convert or upgrade until I think sometime this year. So we're waiting for the government to announce it. So in the meantime, probably go and understand a bit more about Careshield Life and whether you should convert. The advantage, of course, Careshield Life is a lifetime protection versus Eldershield, which is either 60 or 72 months, depending on whether you are the ES, the Eldershield 400 or Eldershield 300, which is even the earlier version. Okay. One other advantage is the payout has increased from 400 to 600, which is basically a 50% increase. But then, of course, there's no free lunch. With it, premiums are adjusted, and also you got to pay premiums slightly longer to age 67. So I won't say yes or no, but to go and look at it in more details, or perhaps even attend one of our talks on Careshield Life to really find out more. Yeah, to understand a bit more before you jump in. Especially for those who have Eldershield supplement, you might want to then sit down with your life insurance advisor, or yeah, to ask them to help you do a comparison before you even do a switch. Okay. All right. Next question: should I buy private annuities or CPF Life? Okay, good question. So both CPF Life is actually a annuity plan. So for those of us who may not really understand what is annuity, so annuity is a form of life insurance. Okay, so CPF Life is an annuity plan. And the joke in the business is that annuities take care of you when you live too long. Life insurance take care of you when you expire too early. Okay, so it's just complete opposite. So the private annuity part, I would say, well, there was a comparison done actually in the Straits Times, I believe in like 2014, 2015. They did a comparison between most of the annuity plans out there in the market. I think 3 prominent companies were featured. Okay, versus CPF Life, the enhanced retirement sum at that time. And surprisingly, CPF Life came up much more in terms of payout compared to to the private annuity plans out there. Yeah, so don't take my word for it. Go and Google. find out more about how they compare it. And the other thing is that, well, if you want to take advantage of the CPF Life top up, you can actually, what you can do now between the time you reach 65 is to top up your either special account or your retirement account, depending on what age. So if you're below 55, your special account. If you're above 65, 50, below 55 is your special account. Above 55, you'll be top up into your retirement account, and you get a tax break. You take a tax deduction of 7,000, and this money eventually will be transferred into your CPF Life policy. And you'll be paid out at age 65. So that's one strategy to look at. But if you still would like the idea of cash, then maybe look at using SRS. So there are SRS approved annuity plans out there. So using SRS, you can also get a tax deduction. I believe it's 15,300 for Singaporeans. Yeah, so that's one way to help you save some more money and get into those plans. Okay, I'm 50. Term insurance can only buy till 65. I need longer protection. Whole life's too expensive. How? Okay. Actually, there are some term life policies out there, but at least they are not available on the DPI Compare First website. Okay, so what you can do is you Google term life insurance. There are some companies offering term life all the way up to age 99, which is almost like a whole life plan. Okay, so one way is to go look for that. Yeah, if you are interested. Of course, the term life at age 50 up to 99 probably would still be cheaper than buying a whole life, because the whole life, a lot of the extra premiums goes into accumulating for the long haul, in giving you a returns. Yeah. Okay, let me see whether there are more questions. Okay. Oh, thanks. Okay, NSmen got this free MINDEF insurance. Should I include this in my life insurance calculation? Army boy. Okay. The challenge with this is that this is free. The moment you leave, you finish serving your NS, it's gone. Okay. But if you like to count it as part of your insurance coverage, then I strongly suggest that you look at the optional scheme that's available. This is the Aviva MINDEF MHA Home Team, Ministry of Home Affairs. They have jointly come together with Aviva to design a group insurance scheme offered to all NSmen and reservists. So you can look at the optional scheme, which can continue coverage even after you leave NS. Okay, or even if you decide to quit the service if you are regular. All right, and this coverage can go up to 65, and it's very, very cheap. It's actually, to use the word cheap. Yeah, it's the cheapest form of term insurance ever found in Singapore. All right. So it's basically you can get up to $1 million coverage on the optional term insurance at $41 per month. Cannot find anywhere else. So if you are a guy, buy it. So later on, when you get married, you can put your spouse and your children on the same scheme. Right. So this is like the best deal ever, and the premium is locked into 65. Okay. So since we are on this, you can also look at under the Aviva Group Insurance Scheme. They also have critical illness coverage. They also have early critical illness coverage. And what else? They have accident. The accident coverage is also super cheap. Yeah. So I think for like $6 a month, you get something like $500,000 coverage or something. Yeah, that one I can't really remember because I'm only interested more in the term life coverage. So go look at the Aviva website. You can sign on online, and yeah, it's that easy. All right. So if you are NSmen now or you're serving reservists, I encourage you to really go and take advantage of this, because the moment you stop reservists, then you're not entitled to have this benefit anymore. So I'm very upset because I served my country, but when this plan was offered, I didn't get a chance. All right. Okay. I want to get a life insurance. insurance with return. I don't like to manage my money and just want a systematic system. Is ILP a better choice, or what would you recommend? Okay, you don't like to manage your money and you want a systematic return. Actually, if you don't like to manage your money, ILP still needs you to monitor the performance of the funds. Okay, and as I mentioned earlier, one of the downside of an ILP, or investment linked product, is this. LP, the mortality charges or the benefit charges increases as you get older. Okay, so this is something that I hope you clearly clarify with your life insurance planners when you're looking at ILP. There are some company that offers ILP products where the benefit, the mortality rates are locked in from the very first day. Okay, but there's far few in between. All right. Most of the companies out there, the life insurance benefits, whether death, critical illness, all increases as you get older. So I feel ILP is not a very efficient tool for protection needs as you get older. It will erode into the returns. Secondly, if you are not interested in managing and monitoring your portfolio, LP is not a good choice, because it's an investment plan. You have an investment account. You first need to select the investment account. Secondly, the investment is very volatile and there are ups and downs. And then if you don't monitor, you don't know whether your policy is doing well or you're losing money all the time. And there's great tendency to lose money on all these unit trusts or ILP platforms, because people get into a fund, they don't know what they are doing, and then after 5 years, they pay all the charges and everything, and yet the fund is not performing, and then they end up coming to talk to people like me and say, hey, Trevor, how come this is not working out? This is losing money all the time. I said, well, have you been monitoring? They said, no, I not look at it from day one since I bought it 5 years ago. Yeah. So if you don't want to monitor, then perhaps look at a whole life plan, yeah, for protection needs, and then it will have some systematic accumulation. Yeah, but then again, like I say, I'm not a big fan of doing that. Yeah. All right. Okay, why do I need home protection insurance when I really have life insurance coverage? Good, very good question. So your home protection scheme, HPS in short, okay, comes under the CPF board. And this is a compulsory scheme that you must take up, especially when you buy, in the case of those of us who buy HDB flat and use our CPF money to pay for the mortgage. So this is compulsory, no running away from it. Okay, I think the CPF board designed this in such a way that in the event something bad should happen, because HPS protects you against death, disability, death and disability. So what happens is that if death or disability takes place, the HPS loan on the home will be paid off. All right. So unless you have got a mortgage insurance taken up, okay, to cover the housing loan, whether it's your HDB flat or your condo or or landed property, then I would say, yeah, you don't need HPS. Okay. In fact, if you have a mortgage reducing term assurance set up, what you can do is you go back to CPF board and apply for permission to have HPS removed. And then you just have to show them that you have this mortgage term insurance in place. All right. So if you don't have a mortgage insurance in place, then I strongly suggest that you keep the HPS, because you don't want to use your life insurance coverage. Right now, you have 400,000 life insurance coverage, and then something happens and you have an outstanding mortgage of say 300,000 is going to go towards paying for the mortgage, and that only leaves your family with 100,000. Okay, so not a good way to go about this. Yeah. Next question. I'm a young parent. Should I buy life insurance for my young children now? Okay. Well, yes, in some ways, because that is what a lot of parents do. They buy a whole life insurance as a gift, and they would maybe look at it as a limited pay policy. Pay the premium for 10, 20 years, and then the gift is given to the kid. Advantage of doing that is, of course, you start the child as early as possible, so the premiums is at the lowest point. Secondly, is also you are locking in on the insurability of the child, because as the child grows up, they may have some illnesses that may become an exclusion on the policies. Okay, so that's one of the big advantage lah. But I would strongly suggest not to insure your child if you don't have enough insurance yourself. Okay, so you first have to get your priorities straight. Okay, so insure the golden goose and not the golden egg, as we jokingly say. Make sure that you have enough life insurance coverage first. Okay, whether it's term or anything that you are planning to do. Once you have that, and then you have spare cash, and then you want to buy a life insurance policy for your young children to take advantage of good health and low premiums, and then you want to give it as a gift when they're older, yeah, why not? So you can even pack in critical illness coverage for them, because it's all very cheap at this point. Yeah, okay. Because any slight problems, like even if they have an asthmatic cough and all that, there will be plenty of exclusions that insurance companies are going to put. Yeah, so that's the big advantage. All right. I hope I answered that question. My father is retired. I'm supporting him. Now he wants me to buy life insurance and sign him as beneficiary. I got no money, so he pay the premium. Like that can. Wow. Okay. Possible, yes. So you can go two ways about it. Okay, one is, yeah, you take it up as a insured, okay, life insured, and then basically he pays the premium, and you assign the policy to him as the beneficiary, and then he becomes the owner of the policy because he's paying the premiums. So he doesn't want you to like suddenly, because if you don't assign the policy to him, then one day you decide to cash out the policy, he has no control. Okay, so that's one way to go about this. So this is a possible arrangement. Yeah, so you would be the policy owner. After it's enforced, you assign the policy to him. Your father can continue to pay the premium. It's perfectly legal. All right. Okay, but of course there are other ways to go about it, where the father is the policy owner, okay, and you are just the insured. Okay, but of course, then the insurance companies will be scratching their head why your father want to buy a policy on his adult child. So it's a bit more challenging getting that done. Yeah, so a more straightforward way is you buy the life insurance policy as the insured, and then he can pay the premium, and then you assign it to him. All right, I think less questions asked with regards to where the whole underwriting process is going to take place. Okay. Have I answered? Okay, I think my agent misrepresented the product I bought. What should I do? Whoa. Okay, that's actually a bit tricky, but it has happened. Okay, and I am sad to say that it has happened. I was in the business for a long time, so it's not a good thing. First thing you can do is, if you feel that your agent has misrepresented the product that you bought, okay, you need to make a complaint to the insurer. Okay, and I think if in the case, if you have done a full fact find, which I strongly encourage all our audience here to do, is when you do a full fact find, there's a lesser chance of misrepresentation and mis-selling, because you've declared all the information fully and your needs are clearly shown to the agent. All right. So that will help protect you in the event a case of misrepresentation or mis-selling comes about. Okay. So the thing you can do is make a complaint first to the insurer. Okay, and by law, by regulations, okay, within 15 days of the receipt of your complaint, the insurer must give you an interim response. So they will probably go in and investigate what's happening and all that. They will have to dig all their files to find out what exactly happened. So that's why I say, if you have all the full documentation done, it's a stronger case. All right. And then within 30 business days after the receipt of your complaint, the insurer should give you a response to whether, what they decide, whether there was a case of misrepresentation, mis-selling, or whatever it is. Okay. So if they find it was a true case of misrepresentation or misselling, then basically they can have the policy premium refunded and the policy cancelled. All right. So that's the first stage. And if that doesn't happen, then you got to take it to the next level. You probably have to approach the Financial Industry Dispute Resolution Center. Okay, so these guys are set up by MAS after I believe the 2008 Lehman Brothers crisis, where the global crisis caused the financial market to collapse. Yeah, so this is an independent organization that resolves dispute between yourself and the financial institution. Okay, so if the dispute cannot be resolved in an amicable way, then you have to take it to these guys, and these guys would then go through a process to help you decide whether there's a case against the life insurance company and the life insurance agent. All right. So of course, this may take a pretty long time. Okay, so this is all going to may take as long as 6 months before you'll be able to determine whether you're going to get some form of recourse. Okay, let me see. Are there some more questions that we have? We have another 10 minutes. All right. Okay. Maybe scroll down a bit. Yeah, okay. I recently got retrenched, cannot afford the premiums to pay now. Should I cancel my policies? Okay, very good question. I mean, this is probably now common, especially with the pandemic, the economic crisis over the last year. So there's something that a lot of people may be facing. I would strongly not suggest canceling your policy right away. Okay, sit down with your insurance planner or your financial advisor. Let them know that you've been retrenched, that you cannot afford the premiums, and ask them what are the options you have. Okay, so if unless it's a term policy with no cash value, then once you stop paying the premiums, the policy will lapse. All right. One way to do this is perhaps if it's a term policy and you really cannot afford the premiums, talk to them and see whether you can reduce the coverage to a point where you still can afford. Because if you totally cancel the product, you're going to be left without any form of coverage, especially things like critical illness and all that. And if you currently have got health problems, then I strongly suggest that you not go down that route, because you may become you're now at a point where you may not be insurable. Just like myself, I at 45, I got diagnosed with glaucoma and mitral valve collapse. So now if I go and buy an insurance policy, there'll be plenty of exclusion and loadings. Okay, yeah, so that's one way. The other way is if you have a whole life endowment or ILP, okay, then there'll be cash value in those policies. For ILP, you can opt to go on premium holiday. Stop paying premiums, but the insurance will still continue as long as the ILP policies has enough units invested in it, enough cash value units invested in it to pay for your benefits. And this could last more than a year. All right. For endowment and whole life, they can go into automatic premium loan, we call it, for at least a year. And you still have all your coverage intact, whether hospitalization, critical illness, or the death and disability. All right. So I would strongly suggest sit down with the planner and explore all your options before you start doing anything. Yeah, especially if you have some pre-existing health conditions now. All right, so that's something that I strongly urge you to look at very quickly, especially now if you don't have any form of income and you basically drawing into all your reserves. All right. Okay, I think there was one or two other questions at the top. If we could scroll back down slowly. Okay. Wow, okay, this is an interesting question. Universal life insurance. Can you explain what's the difference between universal life and normal life insurance? Wow, good questions. Actually, universal life is a different breed of products altogether. Okay, so we didn't quite cover that earlier in the preview. That's because UL or universal life policies, ULP, only became quite common in the last few years, very popular in the last few years. These products are aggressively marketed as legacy planning and giving tools among high net worth individuals. So usually most of the people who are at least mass affluent, people who have like maybe 2-3 million parked with the private bankers, and these guys will start talking to you. So this is very aggressively not just marketed by banks, but even by life insurance companies. All right. So the two main types of ULP available here in Singapore, they are the traditional universal life products, and then there's the variable life universal life product. So the variable ULP is pretty much like an investment linked policy, so not much difference. Whereas the traditional ULP is like a whole life plan. Okay, but the only difference is that in the concept, in the marketing of ULP, most of the time, because you're marketing to high net worth people, they encourage them to pay the premiums all in one go. Okay, so it's usually sold as a single premium policy rather than like a whole life plan where you pay annually. Okay, so single premium, of course, you get some discount. And then on top of that, a lot of these plans are taken up with the concept or idea of premium financing. Yeah, so a lot of the high net worth people, they like the idea, oh, I don't have to pay for all the whole single premium, and I can use a bit of leverage, borrow from the bank to finance the premium on this policy. Yeah, so that's a pretty attractive proposition. Yeah, and then they get a huge payout when death happens. All right. So the two main things to kind of watch out for in universal life products is this. Find out what is the crediting rate. Okay, so in Singapore, the average crediting rate is probably about 2 to 4%. Okay, the problem is that the crediting rate may be non-guaranteed. Okay, so there's a minimum guarantee and then there's a non-guaranteed portion. Okay, so the non-guaranteed portion depends on the performance of life insurers. Okay, so what's the risk? The risk involved is what happens if the investment return is lower than expected and it's lower than your crediting rate, or then you're going to be in trouble. Okay. Secondly, there's a currency risk. Okay, most of these policies are denominated in US dollars, and US dollars is going up and down. All right, so very choppy. So two big things that you want to look at very closely if you're exploring UL is look at the premium financing risk, okay, and then things like currency risk. Okay, so those are double whammies actually. So sometimes it may just somehow backfire. All right. Okay, how many more minutes we have? Probably we can take the last question. We're about 8:23 now. Let me see if there are any other questions I haven't quite covered. Should I buy critical illness as a standalone or as a rider? Okay, let me deal with this. This is depends on what you want out of your critical illness policy. Okay. Actually, a lot depends on whether it's structured, how it's structured on your life policy coverage. If it's structured as a rider on your life insurance policy, then what can happen is that you have an option of either going with an accelerated rider or an additional rider. Okay, so what's the difference? An additional rider simply benefit means if I have my basic life insurance coverage is say 200,000, and then I have another 100,000 coverage on my critical illness, and it's an additional benefit. In the event I get diagnosed of one of the 37 illnesses, the 100,000 will be paid out without affecting the basic policy of 200,000. All right. But challenge with that is most of the time the additional benefits added as a rider to a policy does not cover you all the way to 100. So it will probably terminate at some point at 75 or 80. So this one you've got to ask your insurance planners. The other option is to opt for the accelerated benefit, which means the word accelerated means basically what will happen is that If I claim the 100,000, it will be deducted out of the 200,000 that I'm insured for, which leaves a balance of 100,000 for my beneficiaries eventually when I surrender my IC. Yeah, but accelerated riders tend to cover you all the way to age 100. Yeah. So if you ask me, if you're wanting critical illness to cover you all the way to 100, maybe a better idea is to take a standalone critical illness policy, and then don't have to worry about it. Okay, and then but bear in mind, you have to keep paying the premiums until you get even beyond retirement, which means at 75 when you're not working, are you prepared to cough up this money? Because critical illness is designed for income protection. It's not so much the case of what we call paying for your medical expenses. Of course, you can use critical illness to go overseas to seek treatment where hospitalizations is not covered. All right, time now is 8:26. All right, so let me just quickly maybe answer this last question. Are independent advisors really independent? Okay, so in Singapore, under the FA Act, okay, if you use the word IFA, strictly required by the Financial Advisory Act, you have to be independent. Independent in the sense that you are fee-based financial advisor, you do not collect commissions. Okay, and when you collect fee-based, you are like going to see a doctor who doesn't attempt to sell you medication. Okay, so he's going to be perfectly objective, right? He probably have this guy has no invested interest in earning the commission, right? So he will tell you as it is, but he is going to charge you a fee. Okay, so that's the only guys who are going to be absolutely independent and objective. Everybody else, the licensed FA, the type insurance agents, type insurance companies, or even banks and all that, they all earn some form of commission that is paid out by the product provider. Okay, so that in itself can affect how independent and objective they are going to get. All right. Okay. So now it's 8:27. I'm just going to stop here and get back into my Zoom. All right, so thank you so much for all your questions. So in the event some questions we didn't get to answer them, or you have some other questions that just came to mind, like to encourage you to email them to us at ifl@spe.sg, or you can leave us a message at www.ifl.org.sg. All right, so it's been great answering all your questions. So before you go, just a teaser. My slide doesn't want to move. Okay, so before we go, I'd like to just let you know that our next segment on the 7th of April, same time at 7:30 Wednesday, we'll be bringing to you topic, why do I need to. So in the meantime, please help us to complete evaluation by scanning the QR code on the screen. That will really help us in terms of what are the areas we can make improvements, some of the suggestions, topics that we're interested in. So all that will be taken care of. Right. So thank you so much for joining us, and we look forward to seeing you.
Great job, Trevor.